My name is Matthew Kyle, and I make videos about entrepreneurship and personal finance. This video is going to be all about the stock market and the fact that it looks like in the next few months, we're all going to get another set of stimulus checks. Now, I'm not going to get into the politics behind these checks or who still has to pass what, but it looks like based on a quick Google search, if everything goes as best as possible, we could see these checks as early as the end of September, but knowing how things have been working lately, I would expect something more in the October to November timeframe. All you need to know is that if you received a stimulus check earlier in 2020, you're likely going to get another one as well to the tune of $1,200. So I want to share with you guys my thoughts on these new stimulus checks, the fact that I know a lot of you guys are watching this video because you're thinking about investing in the stock market, and I want to let you guys know my thoughts on that, and I want to give you some things to think about and consider before you do that. First, before I get into this video, I just want to take a step back and highlight something that I think is really interesting and also really dangerous. And that is the fact that for the first time in history, I have never seen this many people, especially in their 20s and 30s, talking about the economy, talking about current events, talking about the jobs market, talking about global trade. So for all of the horrible things that COVID-19 has inflicted upon the world, perhaps there's a silver lining in the fact that it's really shined a spotlight on how fragile our economy is, and it's getting everybody interested in it and talking about it for the first time. And this is really great because talking about finances and financial well-being is the first step in actually being financially well. Even better than just talking about it, people are taking real cash and investing it into the stock market for the first time. For example, there's this app called Robinhood, which basically allows you to buy and sell stocks for free from your couch. They reported an increase from 2020 of over 10 million new users, which is absolutely insane. If you think about that, that is over 3% of the population used that one app alone, of which there are many apps like it, to start investing in the US stock market. That is insane. And again, considering Robinhood is just one of the few major and popular trading platforms, I have to imagine that the real number is probably close to double that of new investors entering the market for the first time, investing their stimulus checks. This is absolutely fantastic. It's also insane and crazy and terrifying at the same time. So I want to explain that to you. We are currently living through what is called a black swan event. And basically that means that we are living through a time that something so extreme and unpredictable has happened, and it has far-reaching consequences that we therefore could never have foreseen or predicted. COVID-19 created a black swan event in the stock market. It created a catastrophe that we could have never foreseen and therefore never anticipated. So here is exactly what I think is happening in the stock market today and where I think it's going. And it's actually a little scary. First, we have a setup for a perfect storm, and it really comes down to three factors. And when I say these three things out loud, it seems like the plot of a movie, but it's real and it's happening, so it's kind of weird. Number one, we have a new virus, the coronavirus, that emerges and becomes a global pandemic. And not only do we have a global pandemic, but this global pandemic shuts down the global economy. And as a result, stock prices become obviously undervalued to the point where people with no technical knowledge of the stock market know it's a good time to buy because things are just obviously deflated. Right after this happens, the federal government literally gives everybody and their mother, literally your mother, $1,200 to invest in the stock market. Well, not to invest in the stock market, but let's be honest, that's what people did with it anyway. People would not be able to capitalize off of that opportunity to invest in the stock market with that free money that they got from the government if it weren't for mobile device technology. And it becomes the combination of the worldwide pandemic forcing a global economic shutdown, which drives stock prices to obviously undervalued levels, at which point the federal government decides to give everybody free money, and we now suddenly have the technology to invest this instantaneously back into the obviously undervalued stock market that we have the current situation today. So this is great. The government comes in, they save the day, they give everybody money, we invest it back into the stock market, we bring ourselves up by our bootstraps, and everybody's making money, and it's all good. Right? Right? Maybe. No. There's some underlying issues that have not been addressed. I don't want to get all math and sciencey on you, but I do want to point out one thing on this S&P 500 chart. And if you look below the chart here, you'll see these little bars. And these little bars basically indicate how many shares of that stock are being transacted every day. So when the bar is very tall, we have a large amount of shares being bought and sold, or what we call a high volume. When the bar is low or small, that's a relatively small amount of transactions happening, so there's less shares of that stock being bought and sold every day. Now, if you'll notice, When the stock market crashed back in March, everybody was selling, driving the price down, and there was a lot of volume. But if you look after March, even though the stock market is rebounding almost as rapidly as it decreased, the volume is very low, which leads me to believe that there's only a handful of investors driving the price up and keeping it up where it is. This leads me to the conclusion that the stock market rally that we're seeing is largely supported by a small amount of investors. And my theory is that this small amount of investors is probably that 5 to 7% of new investors that are coming into the market for the first time with their stimulus checks. This is troubling because first-time investors don't have a mature financial mindset. They don't think long-term about the markets, and they're trying to make a quick buck as fast as they can. Now, I understand that's a general statement, and that doesn't apply to everybody that's recently come into the market, but it really just has to apply to most of them for my theory to be true. And at this point, somebody might say, yes, there are new investors in the market, and that adds a lot of volatility, but look at companies like Amazon and Facebook. Their fundamentals are growing because they're actually more profitable in this pandemic climate. And those are going to be the companies that keep the S&P 500 afloat. To which I say this, yes, certain companies have actually fared better in the pandemic because their business models make them more money when people are at home more, like Facebook and Amazon through Amazon Prime. People aren't shopping, so they're ordering online. Everybody's on social media more, on Instagram and on Facebook. So these companies naturally make more money and they become more profitable as a result of the pandemic. But those prices are still determined by people buying them. Facebook does not set their own stock price. It's not based on their profits and earning or anything. Those are people in the market saying, I value your company at this amount. And I still believe that the first-time investors are setting the price to some extent for these companies, which yes, are technically valued more, but they're not valued that much more. So while these companies are definitely doing better and their financials are strong, their stock prices are not immune to the volatility that comes from having a massive influx of first-time investors in the market buying up their shares. Another thing to think about was that back in March and April, it was really easy to make money in the stock market. You could almost pick a stock at random, and if you held onto it for long enough, odds are you made a really strong return on that investment. You didn't even need to understand the technical aspects of the stock market, how to read a profits chart, quarterly earnings report, none of that. With no technical expertise, it was very easy for all of these first-time investors to come in, make a large amount of money, and leave with a really good first experience. So now we have millions and millions of new younger Americans investing in the stock market, and they all just had an unrealistically good first experience that they're unlikely to ever replicate ever again. And we're about to give them $1,200 to try it. So that's how we got here, guys. Now we're here, what do we do next, and what is going to happen with the stock market? In my opinion, once a lot of these first-time investors suffer their first real loss, they're going to pull their money out, and they're probably not going to be excited to buy stocks again for a long time, so they won't. And as a result, we're not going to see the same kind of rally we saw a few months ago. Because of all of these things, the foundation of the stock market feels a little bit shaky at best, and so for me personally, I'm not going to be investing any money in the stock market anytime soon. I want to let things settle down. I want to get on the other side of this election. I want to see what's going on with the coronavirus, whether or not we can get a cure, and I want to see when states are going to be opening up for business again. There are too many unknowns right now for me, and I'm pretty sure that if the market does go down, it's not going to be a small correction. It's going to go down hard. And so the opportunity to make an extra 15 or 20% on my capital by putting it in the stock market today, I really have to weigh that against the fact that it's a very real possibility that yes, I could make an extra 10 or 15% on that money, but it's very possible that I could lose 30, 40, or 50% of that if we do see another crash, which again, I'm not saying is guaranteed to happen, but if it ever was likely, I mean, the time is really now or in the next few weeks. We just don't know. And for me, I don't want to have to keep my cash tied up in the stock market for 5 or 10 years to try and break even. I have other things that me personally, I'd like to use that money for, like investing in my business, which brings me a really nice return. Now look, it is entirely possible that we really just had one of the largest losses and rallies in the stock market in history, and the sky is the limit, and we're just going to keep going up and up and up. That's absolutely possible. I don't think it's likely that it's going to continue for much longer because at some point reality has to set in. It's important to remember that the stock market is not the economy, and they can behave very differently at the same time. But at some point, the stock market does have to sober up a little bit to the reality of the economy that we're living in, which is civil unrest, political uncertainty, and a global pandemic that really honestly has no end in sight at the moment. So the reality is the marginal upside of making an extra 10 or 15% on my money really is outweighed by the very likely possibility that we could see another crash in the next few months, in which case, unless I want to take a huge loss, I have to leave my money in the market until it breaks even again, which could be a few months, but it could be a few years, and I don't want to tie up my money for that long. The most common advice that I've seen from having watched a lot of these videos myself, just to see what other YouTubers are recommending, is this thing called dollar cost averaging. And the idea behind dollar cost averaging is that if I take, for example, $100 and I invest it at the end of every week in the stock market, regardless if the market is having a good week or a bad week, over a long enough period of time, because the stock market always goes up, at least so far, I'm gonna make money. It's very safe, conservative advice, and I feel like it's something that my grandpa might tell me about being a good citizen and being financially stable, but in this current climate, it just kind of feels wrong. So instead of investing in the stock market at one of the most volatile times in history, I'm gonna recommend 3 other things that you could do with your stimulus check that I think are a better use of the money. The first thing you can do with your stimulus check is put it in a savings account. Now, I know I'm about to get yelled at by people saying that the money is going to depreciate because it earns less interest in the savings account than it does keeping up with inflation, so it actually loses value. But hear me out. Even though we put our money in a savings account and it's technically depreciating a few cents every day, if the stock market does crash, we still have almost all of that money available to invest at a much better time and buy in at a much better position in the market. In my opinion, putting that money in a savings account, even though it doesn't keep up with inflation, is as much of a risk as investing in the stock market today with all of the volatility and knowing that we really could have a major crash in the next few weeks or months. The second thing you can do with that money is pay off a high interest debt that you have. If you have a credit card with a $1,200 balance, which is the amount of the next stimulus check, and it earns the average of a 16% interest rate that you pay on it, you would actually save yourself about $255 by paying off that card immediately with that stimulus check, which is a 21.2% return on your investment paying off that card, which is actually saving you quite a bit of money. The third and last thing that I'll recommend to do with the stimulus check, instead of investing it in the stock market right now, is invest it in yourself. Go out and learn a high income skill. Learn how to code, learn how to do web design, start a YouTube channel. I definitely recommend going on websites like Fiverr, Upwork, or freelancer.com and just search around and see what kind of services and skills are in high demand. And think about learning one of those so you can sell those skill sets to paying clients. And eventually, if you do end up starting your business one day, those skills that you were selling to other people, you can start using towards your own business. Investing in yourself is always a good idea, especially if you're building your skill toolbox. All right, guys, thank you so much for watching. If you liked this video, please hit the like button below. It lets YouTube know that I make good quality information and it helps me share it with more people just like you. Please subscribe to my channel as well. I make 1 or 2 videos a week on personal finance and entrepreneurship topics, and it's all totally free and it's really good information for you guys to have. Whatever you guys end up doing with your stimulus checks, I hope you are wildly successful with it. I hope you guys make a lot of money, and I'll see you for the next video.